Hello everyone. Today's video is all about investing, particularly investing metrics. One of the ratios commonly used by analysts, by investors, is to look at what's known as the ROCE, the ROCE, which stands for Return of Capital Employed. So if you're thinking about investing in a stock, have a look at the ROCE figure. The ROCE is unusual insofar as it actually combines both the income statement, the P&L, and the balance sheet. The definition of ROCE is profit before interest and tax divided by debt plus equity capital employed. So the profit of the business divided by how much debt and equity are in the business, usually stated as a percentage, so multiply that fraction by 100%, and that is the ROCE. Now, a lot of ratios are either P&L only or balance sheet only. So an example of a P&L only ratio would be margin, gross margin percentage, net margin percentage. An example of a balance sheet only ratio would be gearing, how much debt is in the organization. But the ROCE combines elements of both the P&L and the balance sheet. So fundamentally, the ROCE answers the following question. If you were to invest in a company, what kind of return can you expect to get back from the company? Okay, so that's what the ROCE does. You can actually break it down, though, further to get more information from the actual ratio itself. So let's say, for example, you had a ROCE of 10%. And if you do a bit of digging, these figures are often included in analyst research on companies or in the financial reports of companies. But let's assume you've got a ROCE of 10%. So would you be happy with investing in a company that gives you a 10% return? Yeah, maybe. Sounds pretty good. Compared to where else you could put your money these days and not get as good a yield. But fundamentally, you can dig down further and analyze that ratio and say, actually, the profit before interest and tax divided by the capital employed can also be written as follows. Profit before income and tax divided by the sales multiplied by the sales divided by the capital employed. So you're just expanding the ratio, because when you combine them, the two sales amount cancels each other out. But when looking at it in isolation, it could be that you have a figure of profit over sales of 20%, and it could be that you have a figure of sales over capital employed of half. So yes, when you multiply them together, you get the 10% ROCE, but actually you're getting more information by splitting it out and saying, well, okay, the income over sales, 20%, is that maybe too high? And is the sales divided by the capital employed, is that too low? At a half, that only means that half of the capital employed is actually being used to generate sales. So it gives you some more information as an investor when you actually split the ROCE in those two constituent ratios within the larger ratio to say, actually, what looked like 10% was okay. When you drill down, one of the or both of the other figures that make up the 10% could be way off your expectations. It could be that the profit over the sales figure should be a lot lower than 20%, and the sales over the capital employed should be closer to a figure of 1 instead of a half. So you can get more information out of doing a further breakdown of the ROCE figure. This is actually called DuPont analysis in investment jargon, but it's just an expansion of basically the ROCE. But the ROCE itself is quite a useful ratio just to see how businesses are doing, and certainly something as an investor, it's one of the fundamental ratios that you should be looking at if you're thinking about investing your money in this particular business. The downsides of the ROCE are straight away when it's published, it's out of date, because already when you're seeing it, you've got a balance sheet which could be many, many months out of date. So it's not real-time data, it is historic. You get no sense of scale when looking at the ROCE. You could compare a ROCE with a fairly new startup business with one that's a FTSE 100 company, and you could be similar figures, but you have no sense of the scale of the size of the business when looking at the ROCE. Also, the other downside is that it doesn't really give you any idea of the risks, the riskiness of investing in that stock. So ROCE, take it with a pinch of salt. It is a fundamental investor ratio that all investors should consider before investing in a stock. Remember, break it down as well. So not just looking at profit over capital employed, split it into profit over sales multiplied by sales over capital employed. That will give you two different figures, and look at each of those in isolation, just to get a bit of a deeper dive into the ROCE figure. So if you like this video, please do subscribe, and I will see you next time.